Welcome to eVision, the deep dive designed to cut through the noise and get to the core of what you need to know. Today, we're plunging into the fascinating and often pretty misunderstood world of automotive finance.
That's right. We're looking at a whole collection of reports, detailed analyses actually, that dissect the financial strength of auto and truck manufacturers. Our sources cover quite a span, from the latest Q1 2025 data way back to Q1 2024. So a pretty comprehensive view. And the mission, really, for this deep dive is to understand why the, quote, high debt figures you hear about car companies are frequently misunderstood, especially when you start comparing, the traditional global giants to the rising stars of Chinese EV manufacturing.
Yeah, it's a topic that's definitely been making headlines. Some really surprising figures flying around. We'll unpack those numbers, try to look beyond the surface, and reveal the hidden dynamics that truly define a company's financial health in this intensely competitive industry. Okay, let's dive in. So when we first started digging into the data, the thing that really jumps out is just the sheer scale of debt carried by some of the biggest names. I mean, our reports show that in fiscal year 2023, Volkswagen's total debt hit, get this, 3.2 trillion RMB. That's renminbi, Chinese currency. And Toyota wasn't far behind, 2.6 trillion.
Yeah, huge numbers.
Together, just those two, they approach 6 trillion RMB in total liabilities. And you've got Ford, General Motors, BMW, Mercedes-Benz, all hovering above 1 trillion RMB each. What's your initial reaction to numbers that big? I mean, it sounds like a lot of zeros, a lot of risk, potentially.
Well, it is a lot of zeros. But what's fascinating here is that while these figures are, colossal, the auto industry is just inherently capital intensive. You have to think about it. Building massive factories, constantly pouring billions into cutting-edge R&D for things like EVs, autonomous driving, these activities need absolutely massive amounts of capital.
Right.
So a high total debt figure just by itself isn't necessarily a red flag. It can actually be a necessary condition for expansion, for operating at that kind of global scale. It's almost the cost of doing business.
And what's interesting then is when we look at the other side, like some of the big Chinese automakers, BYD, Geely Holding, their total debt levels are, well, notably lower. For instance, the data shows BYD's total debt is only about 1/6 of Volkswagen's,
Right.
even though its sales volume is roughly a third of VW's. So this kind of highlights a clear correlation, doesn't it? A company's overall scale seems to dictate its total debt.
Generally, yeah. Larger scope usually means higher total debt, which, like we said, can be necessary for growth, not necessarily a sign of, poor financial health.
Okay, so clearly the total debt figure isn't the whole story. It makes you wonder, what is the whole story then?
And that raises the really important question. If total debt isn't the full picture, what should we be looking at? And it turns out the structure of that debt is far more telling, specifically distinguishing between interest-bearing and non-interest-bearing liabilities. This is where the real story starts to unfold.
Ah, okay. Here's where it gets really interesting. So our sources suggest we need to go beyond just the headline number and focus on the kind of debt. What's the key difference? Why does this distinction matter so much?
Precisely. So interest-bearing liabilities are what most people think of as, genuine debt. Things like traditional bank loans, bonds, other financial instruments that actually incur significant ongoing financial costs, interest payments. These are the ones that really put pressure on a company's cash flow because of those regular payments. And the data, it shows a really clear divergence here. Major global automakers, Toyota, Ford, GM, they had high percentages of interest-bearing liabilities in fiscal 2023. We're talking like 59% to 67% of their total debt. That indicates pretty substantial financial pressure from those ongoing interest payments. Hundreds of billions, potentially, even if the total debt is trillions.
Wow, yeah. But for major domestic Chinese automakers, the picture is quite different, you're saying.
Completely different. Companies like Series, BYD, they reported interest-bearing liabilities as low as 5% and 6% of their total debt in 2023.
5 or 6% compared to nearly 70.
Exactly. Even Geely Holding, which was the highest among its Chinese peers, was only at 24%, still significantly lower than most overseas companies. This suggests pretty strongly that Chinese automakers face considerably less pressure from those direct financial costs, the interest payments.
It's almost like they're operating on a different financial playing field entirely, isn't it?
It absolutely seems that way. And this huge difference in debt structure points directly to where the bulk of their liabilities actually lie, non-interest-bearing debt, primarily accounts payable.
Yeah.
And this shift, well, it leads us straight into understanding this concept of supply chain finance, which is a major factor in this and what some analysts are calling hidden debt.
Ah, Okay. This is exactly where the recent controversy comes in, isn't it? These whispers of hidden debt, comparisons to situations like Evergrande, which really, sent shockwaves. It makes you wonder how these companies are managing their finances so differently, especially when they claim such low interest-bearing debt. Our sources dig into this. They highlight how Lee Yunfei, BYD's GM of brand and public relations, publicly pushed back against these claims.
Hmm.
He cited BYD's asset liability ratio at 74.6%. And for context, that compares to Ford's 84% or GM's 76%. So that ratio suggests how much of a company's assets are financed by debt. On paper, BYD looks less leveraged overall.
Right, on paper.
And he emphasized BYD's low interest-bearing debt percentage, that 5% figure we just mentioned. So it all sounds pretty good on the surface, but there's a deeper story here.
There usually is. This is where we need to remember that accounting, while it follows rules, can sometimes be, let's say, more of an art than a strict science.
Yeah.
Now, Lee and Fei's numbers, they are factually correct based on standard reporting, no question. But the deeper mechanism at play is indeed this supply chain finance. Here's basically how it works in the auto industry, typically. A large manufacturer, let's use BYD as the example again.
Okay.
They procure massive quantities of materials, parts, you name it, from their suppliers. Now, because of their enormous size and bargaining power, they can demand very long payment terms, sometimes as much as 180 days, maybe even longer in some cases.
Okay, hang on. 180 days, 6 months. So the supplier, who is often a smaller company without BYD's cash reserves, they need cash to operate while they wait. What do?
Wait.
Just wait.
They absolutely can't afford to just wait. So what they do is they take the automaker's accounts receivable, basically, BYD's promise to pay them later. They take that to a bank or another financial institution. They use that promise as collateral for a loan.
Ah. Yeah.
The bank, seeing the strong creditworthiness of a giant like BYD, is generally willing to lend to the supplier, usually at a discount, though. So the supplier gets their cash much sooner, minus that discount, which is effectively the interest on their loan. The automaker, BYD in this case, then pays the full amount to the bank later, fulfilling its original obligation.
Right.
So from BYD's perspective, this transaction just shows up on their books as accounts payable, which is classified as a non-interest-bearing liability. It doesn't look like a traditional loan or debt that accrues interest on their financial statements. Effectively, it sort of hides the financing aspect from a conventional debt viewpoint.
So, okay, the automaker isn't directly borrowing in the traditional sense, but they are getting financing through their suppliers. And the interest cost is effectively pushed onto those suppliers via the discount. This whole intricate setup. It naturally leads to the crucial question, what's the true financial picture look like, especially from an independent analyst's viewpoint, if this hidden debt is potentially significant?
This is precisely what leads some analysts to label it hidden debt.
Right.
GMT Research, for example, they're a well-respected accounting research firm. They actually warned about Evergrande's financial health years before its collapse, partly because of similar kinds of hidden liabilities.
Isn't that quite a track record?
It is. Their analysis suggests that if you take the accounts receivable already sold or collateralized by BYD and you reclassify them, and if you consider accounts payable that are outstanding for more than, say, 90 days as actual debt, then BYD's true net debt as of mid-2024 would actually be around 323 billion RMB.
Wow, okay, 323 billion RMB compared to the 2.7 billion RMB they reported as net debt. That's a massive difference.
A huge difference. And this discrepancy, according to GMT, is largely driven by a surge in something called other accounts payable in BYD's financial statements. These jump from about 41 billion RMB in 2021 to 165 billion RMB by the end of 2023. And these other accounts payable are often vaguely described in financial reports, sometimes just as external current accounts. For analysts, that could be a bit of a red flag because it lacks the detail of typical supplier payables, making it harder to track and assess the real underlying financial exposure.
And what's particularly striking, reading through our sources, is the average payment term. You mentioned Liu Yunfei cited an average of 127 days for BYD's payment cycle, but Bloomberg reports seem to indicate an average closer to 275 days. That's over 9 months.
9 months, yeah. It's significantly longer than the typical 45 to 60 days you might see internationally. Even Tesla's reported around 90 days.
So this incredibly long payment period, and then you combine it with reports of BYD also pushing for like 10% price reductions from its suppliers. That could suggest some pretty intense pressure on the supply chain, couldn't it? What are the risks there?
Indeed. The risk with this kind of supply chain finance, especially when payment terms are stretched that long, is that the financial stability of the entire chain really hinges on the central company's consistent cash flow. Think of it like the auto cards maybe. The big automaker is the base. But if its sales were to suddenly drop, or its cash flow falters for some reason, the entire structure could become unstable very quickly.
Domino effect.
Exactly. A rapid domino effect right through the supply chain, hitting those smaller suppliers who are in effect financing the automaker's operations. So for you, the listener, if you're looking at these companies maybe as an investor or even just as a consumer, wondering about the long-term stability of a brand, it means you really need to dig deeper than just those headline debt numbers. This hidden debt isn't just some accounting technicality. It represents a fundamental risk factor, one that could ripple through the entire supply chain if that central automaker's cash flow gets shaky. It's about understanding the mechanisms underneath, not just the surface figures.
Okay, we've gone deep into the numbers, the accounting mechanisms. Let's pull back a bit now. How do these financial strategies fit within the broader picture, the, intensely competitive landscape of the Chinese auto industry? Because beyond the financial reports, our sources paint this picture of incredibly rapid transformation. Chinese automakers are showing amazing strengths, advanced tech, quality improvements, innovative thinking. They're really breaking into global markets now.
Yeah, absolutely. And a key factor here, which directly impacts their financial models, is their strong vertical integration. Companies like BYD, for instance, they control core technologies in a huge part of their supply chain. We're talking everything from raw materials, battery production, right down to the chips that power the vehicles.
That must give them a huge cost advantage.
It does, a significant one. And this ability to continuously lower costs and manage their gross margins effectively is a really powerful competitive asset. It allows them to offer that highly competitive pricing, which, crucially, helps maintain the robust sales and cash flow needed to sustain that supply chain finance strategy we discussed. It's all interconnected.
Right. But the landscape isn't all smooth sailing, is it? These challenges could directly impact that vital cash flow. The sources point to severe involution within the domestic Chinese EV market. For listeners maybe not familiar, involution here basically means this hyper-competitive environment where companies are kind of forced to innovate and slash prices, sometimes maybe to unsustainable levels. Fierce internal competition.
That's a good way to put it.
And we're also seeing big concerns about overcapacity. China's potential annual car production capacity possibly hitting 70 million vehicles, while global sales in 2024 were only around 74.6 million. That gap is huge. It leads to these bizarre issues like car graveyards, pictures of thousands of new EVs just sitting unused in fields. Some reports show grass growing over them. How do these market pressures link back to the financial strategies?
Oh, they link profoundly. While that vertical integration helps with cost efficiency, the intense involution and the massive overcapacity put immense pressure on profit margins. And crucially, on cash flow. If a company is relying heavily on stretching out payment terms through supply chain finance, its ability to maintain consistent, strong cash flow is absolutely paramount. Non-negotiable, really.
Because if sales slow down or prices crash.
Exactly. If sales slow or prices plummet because everyone's fighting for market share, that cash flow can dry up really fast. And the whole structure built on those long payment terms becomes incredibly vulnerable. Which brings us back to transparency. Probably the most effective way for these companies to address public skepticism and, frankly, ensure their own sustained health is through greater transparency. Supply chain finance itself, it's a legitimate tool used all over the world. But applying it in a way that seems opaque, well, that can lead to misunderstanding and concern. Remember Evergrande, their efforts to reduce interest-bearing debt were completely overshadowed by their hidden liabilities. Similarly, just focusing on one type of debt can obscure the full financial picture here too. The comparison is certainly a cautionary tale. Transparency builds trust.
So wrapping this up, what have we really learned from this deep dive? It seems pretty clear that assessing the financial health of automakers, especially in today's super fast-moving EV landscape, goes way beyond just glancing at total debt figures. It's a much richer, more complex story than that.
Exactly. We've seen how factors like the structure of debt, that key difference between interest-bearing and non-interest-bearing, particularly accounts payable, matter hugely, and the intricate workings of supply chain finance, how that can paint a much more nuanced picture. I think the key takeaway is that the financial stability of companies relying heavily on these extended payment terms, it ultimately rests on their consistent cash flow and their robust sales performance. If that cash flow falters, the whole debt chain, including all those suppliers, could become incredibly vulnerable.
Right. And this brings us to maybe a provocative thought for you, our listener, to consider. In an industry that's defined by fierce innovation, relentless competition, where cost efficiency is absolutely paramount, how much transparency do companies truly owe their investors and the public about all forms of their financial leverage, not just the traditional stuff? And maybe, how can consumers best assess the long-term viability of their favorite brands when the true financial picture might be hidden behind layers of what you called accounting art? Something to mull over as we watch this incredible industry continue to evolve. Thanks for joining us for this deep dive.